Okay, so let's begin. I'm sure a few more colleagues will be coming on the line here shortly, but for now we might as well start. So good morning to all of you in the United States, and good afternoon to those of you in Europe listening. Welcome to our Ducker Frontier webinar on Europe and the life after lockdown. My name is Mark McNamee. I'm the director for Europe, overseeing Western Europe and Central and Eastern Europe research here at Ducker Frontier, and I'll be today's moderator as well as presenter. Before we get started, I realize that some of you may potentially be somewhat new to Ducker Frontier, so I thought I would take just a very quick 1 or 2 minutes to provide you with a brief overview of our firm and how we work with executives at major multinationals. So Ducker Frontier is a market intelligence and consulting firm that provides tailored solutions to drive growth to multinational companies across the B2B, B2C, healthcare, and tech sectors. Continuous research and insights, custom solutions, and transaction support services provide clients with timely and actionable insights to adapt and win in changing markets. Our headquarters are in Washington, D.C., with other offices in Troy, Michigan, New York, London, Paris, Berlin, Singapore, Shanghai, and Bangalore. In terms of our trusted partners, our dedicated teams serve as advisors to more than 300 multinational firms, many of them listed here, as you can see, delivering the market and industry knowledge they need to succeed at all points in the business cycle. For more information, of course, please visit our website at www.duckerfrontier.com. So turning to today's webinar, just some very brief introductions. It is now my pleasure to introduce our panelists for the webinar. So first we have Athanasia Kokinoyeni, who is our senior analyst for Western Europe here at Ducker Frontier. Many of you who of course have spoken with her, particularly the last few months here. She's been with us for 4 years, and previously she worked as an economic advisor for the European Commission. We also have Martin Belchev, who is our senior analyst for Central Europe, who previously worked as a parliamentary researcher in Westminster. And lastly, we have myself, Mark McNamee, and I have been the director of Europe here at Ducker Frontier for the last 5 years. And my primary focus has consistently been, prior to Ducker Frontier as well as currently, Russia and CIS markets. So with that said, looking at today, what we'll be covering in terms of structure, we'll cover a few things, as you can see here, followed by a Q&A session at the end. So first, we'll talk about the global updates that underpin our views for the markets across Europe. Then we will dig deeper into each respective region of Europe, starting first with Western Europe, then Central Europe, and finishing with a quick update on Russia. Throughout the presentation, we'll provide updates not only on our forecast, but also the underlying assumptions behind the forecasts, including, but not exclusive to, government support, progress related to the lockdowns, and the restrictions removals process, while also looking, of course, at the various impacted sectors and their potential going forward. We will then finish, of course, with a Q&A. So if you have any questions throughout, as mentioned, please send them to the host at Ducker Frontier Webinars via the GoToMeeting Messenger by clicking on the Q&A box on the right-hand side of your screen, and we will do our best to ensure that they're addressed in the Q&A section. So with that said, now let's get started by reviewing the global context. So just to very briefly summarize where we've gotten to this point in 2020, I will try to go through this briefly, as it's become quite apparent what has occurred, of course. Naturally, all of this starting in China, and then a drop in both industrial production as well as consumer demand, consumption of services in China, and then, of course, became a global phenomenon, impacting the services sector, transport, and other consumption disruption more globally. This then impacted global trade, services, consumption, and investment, leading in turn to a major drop in all global commodities, including oil and gas, leading to the oil price shock the world has also been simultaneously dealing with, as well as a shock in other global commodities. All of this, of course, has led to the conditions that we have been managing really for about the last 3 months in the Western world, of just generally speaking, lower global demand, considerable currency volatility as well, though a lot of that has subsided lately, but just generally speaking, uncertainty in terms of both execution and operations, in addition to demand planning. More importantly, what we'll be focusing on for the majority of today's webinar will be the outlook for the rest of 2020, but then also into 2021, what these markets will be looking like, which ones will be shaping up better and why. So similarly, looking forward 6 months down the line, 9 months down the line, 12 months down the line, weak demand will actually continue in manufacturing and industrial production overall. This will create, of course, continued lingering difficulties varying by country in labor markets in terms of employment, in terms of incomes, and therefore purchasing power. So therefore, we won't necessarily see a major bounce back in either B2B or B2C demand in the beginning of next year. Weak confidence will continue, particularly with the concerns naturally of a second outbreak, as many people have been discussing, say into Q4 later this year, and other outbreaks at different times prior to the hope for a vaccine by some point, let's say in the middle of next year, in mass production and distribution. On the fiscal side of things, over time, governments will be losing the ability to continue to subsidize the economy during this sort of pause in the global economy. So again, a little bit less support as we approach later in the year, but hopefully the private sector and demand can start to recover in the second half of this year gradually enough to create the conditions for a decent bounce back in 2021. Nonetheless, our expectations for 2021 is a generally speaking sluggish recovery. It'll take some time to return to pre-crisis conditions, and the first half of 2021 will, in our opinion, not likely be that time. There will be considerable sort of hangovers, lingering weaker investment confidence as well, prolonged low commodity prices, good for Western Europe, good for Central Europe generally speaking, but of course can hurt some other markets in the region that are energy exporters. That said, for 2021, there are some concerns, in particular debt overhang. The amount of money that has been taken out in order to sort of get through this global pause, eventually these debts do have to be repaid. So fiscal spending could be impacted quite considerably in 2021 and beyond, not to mention some political and social ramifications, which we'll discuss. Looking forward, the expectation had been for some time that Q3, we could see a sharp bounce back in growth after deep recessions around the world in Q2. This is really a myth anymore. China itself is gradually recovering, which is good news, but they don't have anyone to sell to, at least as of the current moment, because of the recessions in developed markets that they typically export to. As a result, it will take time for both China to continue to recover, waiting for Western Europe's recovery. And while conditions and economic indicators will be improving in this month as restrictions are removed, and in June, Q3 will be an improvement upon Q2, but still a considerable decline in year-on-year terms. And we'll be waiting for more stabilization, normalization into Q4, and then waiting really for general revival into next year. As many of you have been watching in your respective Western European markets, what we're seeing currently the last few weeks to the current week and going forward for the next really 2 months likely, is this sort of template, this generalized process that we've been seeing, that all the countries have been indicating the path that they want to be moving towards in terms of the removal of restrictions progressively. To this point, if you look on the right, you can see various countries where they are currently in this progression. The good news is that most countries now, the primary countries that you see here, had started this process a few weeks back and have made consistent progress to this point. Some, of course, with in some cases restrictions being put back on temporarily, and in other cases with certain restrictions still delayed and in the future, as these countries sort of in a way dance with the coronavirus and try to keep the rate of incidence of the virus at a declining pace. So this is generally speaking how we've been seeing things, and we continue to expect further normalization through a gradual progression along these lines. So when you consider where you're selling, venues that you rely on, this of course can be quite indicative of what you can be expecting that in terms of timelines. Going back several weeks, we've had a number of webinars in other regions of the world, including all of EMEA, but also in APAC and in LATAM. over the last several weeks, and we asked executives there when they expected a pickup in sales in the markets that they cover. As you can see here, Q3 is really when most companies are only starting to expect a recovery in demand. Now, this does not mean a recovery back to 2019 conditions, but simply sales starting to pick up. Over the last 2 months, we've seen a consistent sort of deterioration of sentiment as expectations for sales pickup continue to get sort of pushed back a quarter every couple of weeks that we ask this question. Nonetheless, this gives you some framing for when demand conditions start to gradually revive. And with that said, then I think we'd like to hear from you so we can all understand on your end, when do you expect to return to 2019 levels of demand? So not when sales start to pick up, but actually when you expect the demand conditions pre-coronavirus to return again to your respective markets. So please choose one of the options here: Q4 of this year, the first half of next year, the second half of next year, or otherwise first half of 2022 or beyond. And of course, other is an option if you have not seen your sales deteriorate or frankly don't know. Okay, can we see the polling results? Looks like we can't see the polling results, unfortunately. Can you hide the polling results? Okay. Looks like there might be a tech issue in terms of seeing the polling results. Okay, so I'm being told, so for H2, it looks like 33% for H2, so 2021, which is in line with our expectations. And then it looks like H1 is the next highest response, H1 of next year, with 27% of responses. So sorry we had this technical glitch here, but nonetheless, we'll be sending along the results of the polling afterwards. And you can get another idea. But interestingly, also for H1 2022, 21%. So there is a decent amount of pessimism towards getting back to that. Our expectations are, as it seems in line with yours, around H2 of 2022. And as you can see here, our actual bounce back predictions, as are evident here. A number of countries stand out. I won't go too long into this, but the 2021 bounce back, we will see growth across all of these markets, but in many cases, not even erasing the losses made in 2020 itself. But as you can see, countries like Poland in particular do stand out. So some Central European countries will be outperforming next year, which we'll go into more depth on later. And then very briefly on oil prices, as mentioned, oil prices have actually they've actually bounced back, and these low prices will be a strong benefit for Western European countries in particular. Russia, which we'll discuss later, I'll go into some depth on that, but these low oil prices will help boost purchasing power in the second half of this year and into next year. And then just very lastly, how this impacts potential change in execution and operations, and in particular, we think there are some opportunities. So amid a lot of the sort of negativity, there are a number of opportunities. In particular, we're seeing clients focusing much more on supply chain resilience, so optimizing the supply chain, finding efficiencies and streamlining their supply chains, having closer contact with their suppliers in order to become much more efficient. And then, of course, becoming much more digital, so supercharging digital strategies, as you've likely seen in most of your markets. massive rise in e-commerce, but also importantly, using digital to engage with local partners, using digital to make your internal processes more efficient, internal digital transformation, all of these types of changes going on, which can accelerate the business. So we're seeing a lot of these, some opportunities if companies do start sort of focusing on them at the current moment. So with that said, I'll turn it over to Athanasia here and Western Europe.
Hello, everyone. As Mark mentioned, I'm Athanasia Koginogeni. I'm the analyst for Western Europe, and I would like to kick off the session, the Western Europe session, with another live poll, if I may. So I invite all of the participants in the call to respond to the following question. What year-on-year growth in top-line revenue or sales do you expect in Western Europe in 2020 compared to 2019? Please choose one of the following answers. The first, when you expect some growth. The second, when you expect flat sales. Third option, contraction of 5 to 10%. Then contraction of 11 to 20%. And the last option, contraction of more than 21%. I will give you 1 minute to register your answer, and then we can discuss together the results. I believe we do have the results. The results confirm what we are seeing actually, and we are hearing from the market. They show a 40% majority for contraction by 5 to 10% of sales. We can move to the next slide here. And those results do not come as a surprise, I would say, to what we are seeing. So this answer was also repeated in the time that we shared this live poll once again. That was in the beginning of April. And it seems that businesses have not become more or less pessimistic about a contraction in their sales. It seems that they're more or less pragmatic, that overall there would be a contraction in their sales in 2020 compared to 2019. And it seems that they're not becoming more pessimistic over time. We can move to the next slide. Of course, what we saw in those polls, a contraction of 5 to 10%, is also reflected in our forecasts, our GDP, gross domestic product forecast for the Western European largest markets. Overall, we see a broad-based GDP contraction across the Western European region. Not only for the purely service-based economies, but also for the manufacturing-based economies like Germany. However, we're seeing less of a contraction in those economies there. Overall, we have revised down our forecasts from, of course, the pre-coronavirus period. You can see in the graph in green that we expected some moderate growth for 2020 pre-coronavirus. But the last 2 months, we have become a bit more conservative and a bit more pessimistic about our assumptions for the recovery in the market. So we do think that the recovery will be slow. We are more pessimistic for 2021 forecast than consensus. So we do factor in a moderate recovery for 2021 of at around 3% for Western Europe. And of course, the recovery varies from market to market. You are seeing a stronger recovery in markets that traditionally have bounced back faster from crisis, like the Spanish market. Also, for the Greek market, it would be the same. You are seeing that markets that were the hardest hit from the pandemic such as Italy, are the ones that we have generally a moderate recovery compared to a very steep recession that we are expecting there. We can move to the next slide. In line with the weaker economic forecast are the depreciating pressures we are seeing currently in those currencies in the region. Both the euro to the dollar and the pound to the dollar have been depreciating. Of course, we are seeing much more volatility in the pound to the dollar than the euro to the dollar, and this is because the euro is considered much more than the pound a safe haven currency. So we continue to see continued interest by investors for this currency, and we have seen relatively less volatility than we have seen for the British pound, for instance. Also, the recently announced package by the European Central Bank has been interpreted positively by investors when it comes to the euro. And we have not seen big depreciation pressures there, but this has not been the case for the pound, however, where we've seen that more spending is associated with a spike in inflation. That, of course, is not favoring economic expectations for this market, in line, of course, of Brexit. Overall, with what we can say for currencies is that we do expect a gradual stabilization in the second half of the year, once there will be the start of the recovery more clear. But for the British pound, we're a bit more pessimistic once again, because fears of Brexit will come back online, will still resurface in the last quarter of 2020. And this means that we will see renewed pressures, depreciation pressures driven towards the pound. Let's move to the next slide. In terms of us to understand and really pinpoint a number to the recovery of those markets, we are looking at several factors. We are trying to classify them among two factors: the epidemiological assessment and the economic assessment. What we're looking at the epidemiological assessment are, of course, the number of new cases of COVID-19 in each country, but also the number of new deaths. Of course, in conjunction to this, we're looking at the containment measures. What we're looking in terms of the containment measures is the timing on enforcement of the containment measures, and also the duration of the lockdown, which we have seen from Q1 data that is associated with a bigger negative impact on the economy. Also, where we see strict enforcement of lockdowns, we have observed more of a damage to the economy as well. And also where we're seeing a mandatory quarantine upon arrival, this is something that definitely discourages tourism volumes in the country. Another important component of the epidemiological profile, as seen in Germany most notably, is the testing and contact tracing component. We've seen that countries and governments that have actively tested the population to larger amounts and have developed systems and new technologies for contact tracing have actually contained the virus much more than in other countries. And this has been definitely the case for Germany, where we expect a faster recovery coming online than the rest of the Western European markets. When we move now to the economic profile, of course, what really makes a difference and is a change maker is the recent fiscal and monetary support that has been announced by the respective governments and central banks. We've seen, for instance, that Germany has announced a very generous package that is translated in a faster recovery of the economy, of the German economy, than Italy or Spain, for instance. And the second factor we are assessing for the economic profile is the nature of each economy, which is very distinct from market to market and really varies. And what we're looking is the service, how service heavy an economy is compared to manufacturing. When it's more service based economy, it's more exposed to the COVID-19 crisis. Also, other things we're seeing is the number of SMEs. The higher the number of SMEs, more the exposure of the economy. And also, of course, last but not least, there are also cultural factors that play a very important role. For instance, we are seeing this clear distinction between Northern Europe and South Europe. In Northern Europe, there is more of an inclination to save, and in Southern Europe, there is more of an inclination to spend, which puts at a better place, let's say, places at a better place markets like Greece or Spain to recover at a faster pace, particularly in 2021. We can move to the next slide. By following this framework, we can, yes, perfect. By following this framework, we have classified those markets into buckets. To the left side, you can see the faster recovery markets, and to the right side, the slower recovery markets. Under the faster recovery markets, we have included Germany, as I mentioned before, and also Spain. As well, and to the slower recovery, you can see we have here Italy, UK, and France. The first step towards the recovery, of course, is the easing of lockdown measures, and this is clearly what is driving, let's say, a faster recovery in those markets. So you can see to the left side, Germany and Spain; those are the markets that lifted their restrictions earlier than the rest of Western European five largest markets. And to the right-hand side, you can see UK and France; those markets lifted their restrictions at a later point compared to the rest, but also enforced a lockdown period for a longer period than the rest of the markets. Of course, Italy is a distinct, let's say, example there. It's a distinct case because although the government lifted their restrictions earlier, it has been very severely hit by the pandemic, and we do not assume there, we do not plan for a fast recovery, unfortunately, anytime soon. We come into the next slide, please. For us to understand the pace of the recovery in those markets, quarterly forecasts are very useful. We do have in Western Europe those quarterly forecasts, and what you can see in those quarterly forecasts is a very big drop in economic activity. So you can see here GDP by each quarter on year basis. Especially for the second quarter, you can see a very big drop in economic activity amongst all Western European markets. Of course, there are still variations, as I mentioned, that determine the pace of the recovery of each market. For Italy, for instance, you see the biggest drop. It makes sense, as I outlined the factors behind this already. For Germany there, you are seeing the fastest recovery, also the least of the drop in Q2, but also the faster recovery in Q3 and Q4 respectively. When we will see a more definite start of the rebound? We do think that the more definite start of the rebound will be seen in the last quarter of 2020. And even more clearer in Q1 2021. But when the question becomes, when will we see a full recovery and the economy returning back to pre-COVID-19 economic levels, this will be definitely seen in early 2022. So much later than that. Let's move to the next slide. Of course, what has been an anchor through this time to the economy is government spending, and how proactive government has been to support the economy and attempt to offset the hit to consumer spending that we have seen. You can see, however, that the levels of support really vary from market to market. You can see the leader or the bigger spender, it comes as a surprise, but it's true, is Germany. When you're looking at the fiscal side, so only the fiscal measures here. And if we would sum up the combination of fiscal measures adopted by Western Europe countries, this would be related to tax cuts or tax deferrals, wage subsidies, definitely that is a strong measure that has been implemented, unemployment benefits of all different sorts, but also moratorium or mortgage payments. So those would be this would be broadly the spectrum of different fiscal measures. On the flip side, you're seeing there that Italy or Spain are the governments that will spend the least. To the very right, 1.9%, 1.4 of GDP for both Spain and Italy. Let's move to the next slide. Of course, apart from the fiscal side, besides the fiscal side, we have seen that central banks, and particularly the European Central Bank, has actively tried to support those economies by providing credit lines, by providing liquidity support, by easing collateral. And we have seen that the leader to this practice is, of course, once again, Germany, where Germany has provided an unlimited backstop to its companies through the European Central Bank. But of course, it makes sense because Germany has more of the fiscal leeway to do this. Also, it's a major contributor to the Eurozone budget as well. So it makes sense that it combines a very strong fiscal and monetary package, and it gives definitely an advantage in terms of the pace of recovery for Germany. For countries that are not in the Eurozone, currently, they would not have access to this very big, let's say, pot of funds, and it makes sense for us to see more volatility in their currencies, or more, let's say, pessimism around the pace of the recovery for those markets. We can move to the next slide, please. And a component of the GDP that has been definitely very much affected is consumer spending. And what we're seeing there in terms of consumer demand is a contraction in all of those markets. What is driving this contraction? An increase in unemployment, particularly in the services sectors, retail, tourism and travel, hospitality and food services, the most prominent sectors. Also, we have been seeing a decrease in disposable income in all of those markets, despite the government support, the government wage support. We have been seeing that particularly temporary and short-term workers are very much impacted by this crisis. And another important component related to price sensitivity is that consumer confidence has reached bottom lows in most of those markets, in all of those markets, I could say, along with retail confidence. Of course, it makes sense and it's linked to the lockdown measures. We can move to the next slide. Of course, a question that we are receiving from businesses we work with very often is how long we think that this shift of consumer behavior will last. And this has to do also with the retail trends. We are seeing the online sales that have strengthened in line with the pandemic. Looking at several surveys, particularly this one is from the McKinsey Global Consumer Demand Survey. When they asked many companies globally, on a global scale, how long they think that it would take for consumers to return to their pre-COVID-19 habits, there was consensus overall that this will take quite some time. So it will not be definitely a short-term thing. It will take more than even 4 to 6 months, particularly for the home working trend and the office buildings segment performance. What we are seeing is that home working could become something permanent for many companies globally, and especially in Western Europe, where there is very good infrastructure, let's say for home working trend, for home working, like very good internet connection, and so on and so forth. We can move to the next slide. In terms of consumer behavior in the retail and physical stores, there will be definitely more of a permanent shift there. And where we identify this permanent shift through this survey that is also a McKinsey survey, we are seeing that consumers are much more hesitant than they were before to return to physical stores for their purchases. This is evident across most markets. However, there is an exception for grocery sales, for grocery purchases, where there would be in some cases some return to old habits. Definitely, there is an agreement that consumers will be very reluctant to shop to malls, to big shopping centers, and in some instances to travel as they did before. Where we see more strongly, let's say, an intention to return to the traveling patterns is among the Germans and the French. We can move to the next slide. Yes, in general, it is the retail sector that will be one very much impacted by the pandemic. Of course, it's the airline sector and the accommodation sectors, but also the food services sectors. You can see our assessment of impact to COVID-19 by sectors in this table. However, there are mixed signals from other sectors, like the technology sector, where we see a faster recovery also in the long term, but also in the transportation sector, we do expect faster long-term recovery. And there is a positive performance in the pharmaceutical sectors, in the essential and food manufacturing sectors as well. In the rest of the sectors, we would identify them as risk sectors overall, including also the construction sector that you can see at the bottom of the table. We can skip this slide. Of course, there are other opportunities in the digital space that are developing and then emerging in light of this pandemic. Several sub-segments that we identify is everything that has to do with home supplies, food and beverage, online sales. We are seeing that there is an increase. There is a considerable increase compared to before. Home equipment, online sales, everything also that has to do with home entertainment, digital news, video games as well, and everything that has to do with cooking at home and equipment for cooking at home as well, and everything related to the home working trend, where this is video conferencing or remote learning. So new technologies that are emerging and new opportunities for investment in those areas. And in the healthcare space in particular, we have seen a clear winner of this crisis to be the telemedicine, let's say, businesses that we have seen that they have obtained, let's say, that regulation has eased to facilitate their activity in very major markets like Germany, and we're seeing clearly an opportunity there. We can move now to the Central European region with Martin Bochev.
Thank you so much, Atansia. So I'll just start off by saying that what we've seen in Central Europe is that governments have really moved fast and decisively in imposing restrictive measures in combating the coronavirus. However, as my colleague Mark mentioned, we've seen governments across the region gradually lifting restrictions. And the chart here really represents the plan of the Czech Republic to open up the economy. And we believe that other governments will adopt and amend their plans in a similar manner. There are really several key takeaways from this. First is that opportunities will emerge gradually, and keeping in mind the timing of opening of those restrictions will be crucial in capturing emerging opportunities. The second key takeaway is that the gradual lifting of these restrictions will dictate the available channel opportunities and how MNCs reach out to customers in general, meaning that digital channels will become ever more important. On the next slide, you see our forecasts for GDP for the region, and I'll just start off by saying that previously we've seen the region really build up a strong middle class and strong fiscal and economic cushion, with which it was protecting against external shocks. This is no longer the case because of the coronavirus, mostly because the shock now comes from both weak external demand, especially from the Eurozone, but also global contraction, and because of the internal restrictions that have also impacted domestic demand. In this sense, we see that since industries have been struggling, services as well, we are seeing an uptick in unemployment, which will also drive consumption down. The important thing, however, is that because of the strong economic, otherwise strong economic fundamentals of the region in terms of flexible employment markets and competitiveness, we do expect the region to experience a more pronounced uptick in 2021 and a stronger recovery compared to other emerging markets. On the next slide, we'll talk a bit about the aforementioned consumer spending and domestic demand. So consumer spending has been a core driver for the region in the last several years and have been outperforming. However, what's happening now is because we've seen the hit on domestic industries, we've seen consumer confidence really eroding and taking a significant hit with car registrations falling significantly. This has naturally impacted retail sales and overall consumer demand in general. This means that consumers will remain price sensitive and likely will become more acutely price sensitive in 2020, and we do expect again some recovery in 2021. This makes focusing on value to capturing existing opportunities really crucial in the current environment. Additionally, the lower consumer demand will also have a negative spillover effect on local producers, which will experience, which will be a source of lower B2B demand and will show similar price sensitivity and focus on value. As a result of all this, both consumers and businesses will be more likely to trade down. But again, we do expect some improvement, more considerable improvement next year. Now, on the next slide, we'll talk briefly about the fiscal situation in terms of public finances and public revenues in Central Europe. I think we're having some technical issues. There we go. So the chart here, on the x-axis, we can see public deficit as percentage of GDP in 2019. On the y-axis, we see government revenues in 2019 as a percentage of GDP, and the size of the bubble represents public debt as percentage of GDP. The main takeaway here is that really Central European markets have been very well positioned to introduce some fiscal measures, and they're in an otherwise good financial spot when we talk about public revenues. The biggest outliner here is Romania, where we've seen much stronger public deficit and lower government revenues, which actually limits the space, the fiscal space for Romania to introduce effective anti-COVID fiscal and monetary measures. And you can see this represented on the next slide. Here we see Poland, Hungary, Romania, and the Czech Republic, and we see how those dynamics interplay. So when we refer to below the line measures as percentage of GDP, we talk about loan subsidies and financial injections to corporations. As you can see, there is a very strong disparity between countries in Central Europe, such as Poland, Hungary, and the Czech Republic, and Romania, which, as we already mentioned, is experiencing considerable issues in terms of its public financing and revenues. When we talk about above the line measures, as you can see here on the dark blue bar, this refers to direct fiscal injections and tax cuts that impact the economy at a much more expedient manner. And we see a similar story here where Poland, Hungary, and the Czech Republic have implemented much more drastic measures to battle the COVID outbreak, while in Romania, the measures are still somewhat lacking. Just speaking broadly, when we talk about those fiscal measures, we talk about wage subsidies, loan guarantees, tax credits, additional liquidity support, and hard public spending. Now, all of those have come in similar form throughout the region, but again, the size of those measures differ significantly, and this is why we expect weaker performance in Southeastern Europe than in Central Europe. On the next slide, we can see how regional currencies have been performing against the dollar, and really the main takeaway is that we've seen regional currencies easing significantly against the dollar in 2020, but we do expect them to strengthen slightly in 2021 as growth returns. The reasons why currencies have weakened so significantly in 2020 is because sour investor confidence against emerging market currencies in general, lower economic performance, and the potential credit downgrade. This is again especially true for Romania due to its public fiscal situation, and really looser monetary policy across all markets. And we've seen even the otherwise hawkish Czech central bank introducing significant cuts to the interest rates. On the other hand, when we talk about the euro, we again have seen some easing of these currencies, but it's not as significant. And this is mostly because of the aforementioned sour investor confidence. Again, the only exception is the leu, which, because of the potential credit issues and public finances, we do expect the currency to the leu to not see as the significant strengthening as others, and to actually weaken against the euro in 2021. On the next slide, you can see how industrial production has been performing in Q1, and naturally, industrial production has declined significantly, most significantly in the Czech Republic, Hungary, and Slovakia, which are much more exposed to external demand fluctuations. Hence, we see these sharper drops, and hence why we expect those markets to perform to contract more than let's say Poland. The recovery going forward will be led by durable goods, consumer electronics, and food processing, and this is because we expect the main driver for growth to be again consumer demand. On the next slide, we can see on the x-axis impact of restrictions of current restrictions on individual sectors versus size of employment in each sector, and the idea here is that each sector has felt the impact of the restrictions in a different way, and we've seen service industries such as accommodation and food service activities to be much more impacted than let's say manufacturing, human health and social work activities. And this is really important to keep in mind when assessing the timing of the recovery and which sectors to prioritize. And on the next slide, we can see the timing of some of these sectors. And again, just to highlight, we've seen healthcare, pharmaceuticals, and medtech performing much better, mostly because of the increased demand. We do expect lower demand for durables, mostly because of the low consumer confidence. But we do expect manufacturing industries in general to see a stronger pickup in 2021, despite the overall impact on the industries in 2020. And with that, I would like to conclude and pass it over to my colleague, Mark.
Great, thank you, Martin. So just to wrap things up here, I'll just briefly give the overview for Russia and its outlook, and then we're open to any questions, of course. So we've gotten a couple, so I'll get to those at the end after we take a look at Russia. So one of the issues related to Russia in terms of the outbreak and the economic outlook in this period and going forward is the fact that from the ground up, the social compliance with restrictions has been quite low in Russia, relatively speaking. So not only did Russia initiate a lockdown quite late at the last days of March, so a couple of weeks in some cases after most Western European countries, but also the social restrictions, so the social compliance as sort of monitored by Yandex's self-isolation index. As you can see here, the higher you are on this chart indicates the greater social compliance with restrictions, the less people on the streets, and the lower indicates, of course, just sort of normal day-to-day activity. You can see on the far left, in March prior to the lockdown, there was this was generally speaking normal conditions with a lot of people on the streets. With the lockdown in the first couple of weeks, we did see considerable social compliance, but consistently declining ever since. This is why Russia has become the second largest country in the world in terms of coronavirus cases. This unfortunately has prolonged the outbreak. And of course, Russia's not reached peak cases. The hope is that this will come in the next week or so. But nonetheless, this then likewise delays the removal of restrictions and therefore the end of the lockdown. So the lockdown has been extended in Moscow and St. Petersburg until the end of May, with the hope that Russia across June will face a removal restrictions process as we're seeing in Western European countries currently. The other component of that, of course, is the fiscal support. So as noted, as Athanasia and Martin demonstrated in their countries, Russia, by comparison, is spending about 3.3% of GDP. Now, this is in total spending, and this includes both fiscal but also monetary spending. In terms of fiscal spending, we're talking about less than 1% of GDP, which compared to most European countries, most countries in the EU, this is a very small amount. Even compared to a country like Kazakhstan, this is a quite small amount as a percentage of GDP. Fortunately, what has occurred is that it seems that Putin has actually become more interested in providing greater fiscal support, likely related to some of his drop in his political support rankings. But nonetheless, there was a third fiscal package recently announced, which Putin seems to have fought for greater spending than the Ministry of Finance had initially wanted. And then there's also another plan coming by June 1st. Fortunately, with oil prices, frankly, relatively speaking, of course, a little bit more elevated than where they had been a week ago or a month ago even, this can allow the government to be a little bit more confident to give a little bit more support. Nonetheless, the main point about this spending package, very critically, the point here is that the previous two spending packages failed to support small and medium enterprises well. This third package gives considerably more support to SMEs. That said, there are concerns about unemployment, which has doubled in the last month, and many firms confirming that it's sort of too little too late. That's also been demonstrated, at least as of the latest survey data at the end of April, that showed that over 50% of SMEs across the country had in fact shut down, and that was over 3 weeks. That was roughly 3 weeks ago. Of the remaining 44% continuing to work, the vast majority have seen steep falls in economic demand. That said, with social compliance sort of fading and with restrictions likely to be taking off next month, the conditions should start to improve gradually. In addition, 50% of respondents had claimed that they were not eligible for state support at the time. This is actually now, this is an improvement because of this new fiscal spending package. So most of that 50% should be getting more support. Nonetheless, if you can see from here from the charts, steep drop in demand, and in the chart on the right, you can see the challenges they're facing. Most of this relates to wages. Again, the at least minimal positive news is the fact that the government now is stepping in with considerably more direct support to help deal with the wages and also the taxes and rent pressures. On the consumer side, there's likewise, with that rise in unemployment, we've seen a lot of pressure on consumers. So as you can see from the chart here, about 42% of Russians, as of a little over a week ago, had complained that they effectively had no savings or savings for up to a month from now. This, of course, is quite considerable, and this is going to have lingering consequences for the rest of the year because of this sort of drip feed fiscal support to the market, this lack of savings, these drops in incomes. This is going to cause lingering job cuts, pay cuts, and then also, when you're looking at 2021, a slightly smaller and more hesitant, price-sensitive middle class into next year as well. So lingering issues in terms of demand. So you're not going to see a rapid pickup, say, at the beginning of next year. A general recovery more or less towards the second half of next year. So in terms of our forecasts, if you see here, minus 3.1% for GDP, minus 3.5% for consumer spending. Again, a bounce back next year, but nothing terribly dramatic. Not as high, for example, as Central European countries, but nonetheless, certain things are allowing the Russian economy this year to face a slightly less worse recession, I could put it, than, say, numerous Western European markets. A couple of those things are the fact that, as Athanasia had mentioned at the outset, Russia is a little bit less exposed because it's not as much of a service sector-based economy. SMEs are only about 15 to 20% of total GDP. Public wages constitute a vast amount of total wages in the country compared to most Western markets, where, of course, private sector wages dominate. So some of these things then help sort of contain the negative economic ramifications of these lockdowns and the global recession. Nonetheless, we still expect a considerable recession this year and continued contraction in Q3 and only normalization into Q4. Our ruble expectations are actually not terribly bad, to be perfectly frank, particularly in light of the severe drop in energy prices. The central bank has intervened for the last 2 months consistently, has vowed to intervene with another $30 billion through this coming September, if necessary, in order to stop the ruble from falling really below 80 to the dollar. This has significantly helped ruble performance this year, and that's why we actually don't see too terrible at least much further depreciation from current conditions. And a final word before we get to just 2 questions that I see we have are the political implications to take into account. On the one hand, there is an increasing likelihood of Biden winning in the United States elections later this year. If that happens, look out for more sanctions coming from the new Democratic president, who'd want to sort of get revenge in a way for the loss of Hillary Clinton in 2016 and the Democratic Party blaming Russia for that loss, however accurate or inaccurate that may be. And that's matched with, of course, President Putin facing, frankly, his biggest political test of his entire tenure as president, with major political events around the corner, with Duma elections next year, constitutional reform potentially this summer, a vote on that. Meanwhile, his popularity has dropped to historic lows. So I'll leave it at that for now. I do see we do have a question, so I wanted to ask Athanasia just quickly. I think we'll just, deal with this one question for now. Athanasia, we have a question about travel and tourism in Europe following the lockdown. So is there anything further you can say about the end of the lockdown, travel and tourism? And we do have a slide on that, which we didn't get to, so I'll go there to help you start answering the question. But Athanasia, I'll hand it over to you.
Thank you, Mark. So it doesn't surprise me that we got this question, actually, because this is something that businesses really would like to know right now in order to set the right assumptions. Overall, we think that international travel volumes will not reach the pre-COVID level up until early 2022, even possibly in 2023. And in terms of tourism volumes in 2020 compared to 2019, we will see a decline of at around 70%, most likely. And this is because of several reasons. It's because of the travel bans that are enforced in several countries currently, particularly right now from the European Commission for non-EU incoming flights. This means that there will not be a recovery, as I mentioned, in the short term for international flights. Where we will see some improvements will be in domestic flights, not international flights, domestic flights, where we will see the first step of the recovery happening, which means some strength to the hospitality industry and accommodation. This would be in the midterm. And in terms of when the EU travel ban would be lifted, this would be certainly after June. So we could speak for the lifting of the travel ban in July or in August when it comes to non-EU flights. But the traveling experience will be nothing to what we were used to before. There will be really the new normal in traveling, whether this has to do with health certificates that are obtained before arrival, whether it has to do with testing upon arrival, or it has to do with the mandatory quarantines upon arrival.
Great. Okay. Thank you, Athanasia. I don't have much to add to that. I think that's good insight. As best as we can know at this point, frankly. We've seen wild forecasts for what can happen to the travel industry, with even the most negative scenarios saying that we won't really see a return to normal until the middle of next year after a vaccine. So it could take some time to return to normal, but in the meantime, there could be clearly an opening up under certain conditions and for certain countries. With that, we've gone well past the time here, so we'll leave it at that for now. I just want to thank everyone then for your participation in this webinar. If you'd like to follow up with us on some of the materials we've showed, please reach out to your client relationship manager. They will also come back to you with answers to any questions that were asked, which we weren't able to discuss with this webinar, as we just went a bit over here. So thank you everyone on the line for joining us, and we look forward to speaking with you again soon. Have a great rest of your day.